Today we are analyzing Howmet Aerospace, ticker HWM. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. The company has a market cap of $20.1 billion, enterprise value of $23.6 billion. You see about $3.5 billion in net debt on that business, about 15% of the overall enterprise value, operating in the aerospace and defense industry, which tends to be a fairly good industry. So Howmet Aerospace provides advanced engineering solutions for the aerospace transportation industries. This is the key one here, engineered solutions. U.S., Japan, France, Germany, U.K. So basically just like the NATO side of the defense industry. It operates through four segments: engine products, fastening systems, engineered structures, and forged wheels. So they have airfoil, seamless rolled rings, and aircraft engines, aerospace, fastening systems, commercial transportation, keyword here, commercial, engineered structures, has ingots, mill products, aluminum, nickel, forgings. These are key, very metal products here. Aerospace and defense applications. Forged wheels is aluminum wheels, heavy-duty trucks, commercial transportation segment. So not all in the defense industry, not all in aerospace, but those seems to be the main ones that they are in, based in Pittsburgh, Pennsylvania. 1.26 beta, slightly more volatile than the average S&P 500 company. Let's look on the return on invested capital. So we're going to skip the 2014 number here. This could be a spin-off date or something. The data doesn't go back any further than that. They lost money in 2015, lost money in 2016, lost money in 2017. So 3 years of losses, and they've been profitable since. The biggest downside I see here is if I just look favorably and say, hey, these years maybe aren't representative because they've been improving since then. You're basically lost money in almost half the years here. 3 out of 8. So not half, 40% of the years, 3 out of 8 years you lost money. But even in the years you're making money, your highest return on invested capital is 6%, 5.99, rounding to 6%. These are pretty low returns on invested capital. I'd really like to be above this 10% line. We don't have a single year in our data set here showing that I'm above that line. We have pretty low gross profit margins, 24%, 14%. The reason I highlighted these, ingots and forgings and stuff is those don't sound like very high margin products. Although the engine product segment is probably, higher margin, some of these other segments seem like they're probably lower margin, and you see that with this 24% gross profit margin. EBIT margins at 14%, pre-tax at 3%, of course, negative free cash flow right now on these 10-year median margins. Overall return on equity is pretty low at 6%. Return on invested capital 2.47%. These are below average company numbers. I wouldn't even say this is an average company at this point. These look like a below average company. And the downside is we see that this is trading at a very high price. PE of 37, 38, price to book of 5, price to sales of 3. All of these EV to EBITDA numbers, EV to EBIT, EV to free cash flow suggest that this isn't a one-off problem. It's pretty highly priced across the board. On top of that, you don't have 10-year CAGRs. That's because you just don't have the history. But we can clearly see they started at $12 billion in revenue, and you're down to $5 billion in revenue. Now, there was a big drop from 2017 to 2018, so I would guess maybe there was some sort of spinoff. This is a slightly different business since then. But even if we just take this 2018 to 2022 number, revenue's down. If we take 2019 to 2022 number, revenue's down. Basically, we're saying this is a declining business. I'm really not interested in declining businesses. You're seeing gross profit margins gross profits are down from 2.1 billion to 1.5 billion, from 2018 from 1.6 billion to 1.5 billion. So you're losing money here. Not losing money, but you're shrinking. It's really hard to value a shrinking business. Operating profit of 900 million. You do have $1 in EPS, but of course, trading at 48 dollars per share. This is an extremely overvalued company based upon what I'm seeing here. You don't have a single year that's really that much more attractive. You're earning $1.30 in 2018. So even at your peak earnings, this is a highly valued company. It's not like it's growing quickly, so you can't expect growth to help you out here. I really don't see anything in this that makes it super appealing to me. You're seeing a high price, very average to below average results, average results here, below average results here. So not very appealing so far. Hopefully we'll learn some more with the income statement, balance sheet, and cash flow statement. If you're enjoying this video, if you learned something about the company, hit that like button. Great way to support the channel, even if you don't like the company. So please consider doing that. So income statement. Again, your gross profit is declining here. They did shave off a bunch of the cost of goods sold when they shrunk down on revenue. So that does help. They're able to shrink some of their overhead, SG&A, shrunk their R&D, operating expense. Again, all of that's looking like some sort of spin-off or sale of the company right here. Unfortunately, they don't really have much change in the shares outstanding over the course of the decade, 439 million to 421 million. It is down, but it's not down even as much as 10%, so I can't really count on that being a modifier going forward. If you just reduce your shares outstanding by 5% over the course of a decade, that's less than 0.5% per year in the EPS improvement, so I really am not going to count on that. Now, you do show net income growth over the course of the decade, 268 to 532. You've basically doubled your net income, but again, you're just so astoundingly overvalued at $1.26 EPS compared to that $48 stock price that it's almost irrelevant how expensive this company is when they're actually shrinking on the top line. Let's look at our balance sheet. You're not going to be bailed out by cash. It's not like you have a lot of cash built up on the balance sheet. Your PP&E is $2.4 billion. So let's take that quick look. $2.4 billion to net income. So you're not really being bailed out there. It is pretty capital intensive. You have a bunch of goodwill here, looks like from past acquisitions. A bunch of inventory as well, $4 billion. You're just getting low returns on this business. You have a lot of inventory, you have a lot of PP&E compared to the size of the revenue, and you also have $4 billion here in debt. Now, it is good that they brought the debt down. They brought assets down a ton. It was $36 billion down to $10 billion. So a big reduction in your assets. So that is a good sign that they've been able to manage their assets and liabilities well. So the balance sheet seems to be managed decently well, but it's just so much in terms of assets compared to their earnings. Lots of changes in working capital every year. That's very interesting. I guess this is just managing the decline in the business. You can see they're investing much less in PP&E today than they used to. They only started the buybacks about 5 years ago. I don't know. There's nothing exciting in this business. So for me, I'm going to pass in Howmet Aerospace. It looks like a below average company, below average returns on invested capital, negative revenue growth, extremely overvalued price at 38 PE. Won't hit my watch list. Thank you for listening. If you learned something, hit that like button. Companies you would like, I'm covering every company in the S&P 500. My watch list companies are in the playlist up above. And my affiliate link to quickfs.net, this software that I'm using to study this company, is in the show notes below. It's the first link in the show notes. Please use that link to support my channel. You can sign up there. Free or paid accounts can help you analyze companies in short 10-minute bursts. Thank you for listening. Until next time, stop paying fees, start building wealth.